HSBC and Standard Chartered lost a combined several billion pounds of market value in 2 sessions, and the surface explanation is that China told them to stop opening Hong Kong accounts for mainland customers. That is accurate but incomplete. The directive came from the China Securities Regulatory Commission on 22 May, targeting unauthorized cross-border brokerage activity, not deposit-taking broadly. What moved the stock was not the circular itself, but the South China Morning Post's reporting that banks were already executing it by suspending new account openings at mainland branches. The share moves, HSBC down 1.8%, Standard Chartered down 2.8% in London Thursday, then another leg in Hong Kong Friday, with Standard Chartered sliding 5.1%, suggest that foreign institutional holders treated the news as a structural repricing event, not a technical compliance update. Prudential and AIA fell harder, losing 7.6% and 6.75% respectively, which reveals where the positioning pressure was most concentrated: wealth and insurance flows from mainland high-net-worth individuals into Hong Kong domiciled products. Citi's analysts moved quickly to argue the sell-off was overdone, and their arithmetic is precise. Assuming 0 new non-resident Chinese accounts, HSBC's 2028 revenue falls by roughly $1 billion, or about 2% of group profit before tax. Standard Chartered's exposure is smaller still, around $200 million. That framing should have arrested the fall. It did not fully do so, which means the market is pricing something Citi's static model does not capture. The unresolved question is not how much revenue the circular takes away. It is whether the circular is the first regulatory move in a sequence that progressively narrows mainland access to offshore financial products.
The divergence in capital flows on the same day makes the HSBC and Standard Chartered positioning unusually readable. While foreign institutional selling rotated out of FTSE-listed China-exposed financials, UK retail capital moved in the opposite direction, not into domestic equities, but into Hargreaves Lansdown's SpaceX IPO allocation. Hargreaves Lansdown reported 35,000 retail investors had registered IPO alerts since April, and the platform extended help desk hours to manage demand ahead of the 10 June deadline. Revolut and eToro are acting as permitted intermediaries, and SpaceX has set aside up to 25% of its $75 billion float for retail participation, a share 5 times the typical institutional IPO allocation structure. This is not merely coincidence of timing. The same UK retail base that would historically have bought into an HSBC rights issue or a Standard Chartered recovery trade is instead deploying into a NASDAQ-listed company valued at $1.77 trillion that lost $2.6 billion from operations last year on $18.7 billion in revenue. The S&P 500's decision to bar SpaceX from fast entry, the index requires 12 months of listing and GAAP profitability, removes one forced fire class from the stock's post-IPO structure. Passive fund managers who track the S&P 500 are not compelled to buy on day one. That shifts the price-setting role in the first weeks of trading toward the retail participants who entered at the IPO price of $135 per share. Hargreaves Lansdown's position as the exclusive UK retail gateway, managing over £200 billion in assets under administration, means UK retail concentration in this single IPO is structurally higher than in any prior overseas listing. The platform absorbed more than £1 billion across primary market transactions in the past 18 months. The SpaceX allocation will test whether that appetite is durable at a $1.77 trillion entry point for a loss-making business.
Both the HSBC and Standard Chartered selling and the SpaceX retail surge become more coherent when read against the UK's domestic rate environment. Halifax reported on Friday that house prices fell 0.1% in May, the third consecutive monthly decline. The year-on-year gain of 0.5% is less than half the 1% economists had forecast. Amanda Bryden at Halifax named the mechanism directly. Higher inflation expectations have kept borrowing costs above January levels, despite lenders cutting headline rates, and the energy shock from the Strait of Hormuz, still effectively closed, continues to feed into inflation prints. The Bank of England's next meeting is 18 June, and market pricing has shifted materially since the Iran war began. A year ago, rate cuts were the consensus path. Today, investors price 1 to 2 quarter-point rate rises by year-end. ING's economists flagged a July hike as possible if Hormuz flows do not durably recover. Average mortgage rates have risen by almost a full percentage point since the conflict began. This rate reversal is the structural context in which both other moves sit. FTSE-listed financials with China exposure are being sold not only because of the CSRC directive, but because the domestic rate environment no longer supports the credit growth and wealth management expansion that justified their Hong Kong premium valuations. UK retail capital is leaving domestic savings products and domestic property, where a third consecutive price fall signals mounting affordability pressure, and migrating into a high-conviction overseas growth story before the Bank of England closes the rate environment further. The verification point for this reading is the 18 June Monetary Policy Committee vote count. If the number of MPC members voting for a rate rise increases beyond 1, economist Hugh Pill was the sole dissenter at the last meeting, the capital flow pressure on FTSE-listed China financials and the domestic property market intensifies simultaneously. Citi's $1 billion revenue haircut for HSBC holds only if the CSRC crackdown is contained. If June's MPC produces 2 or more rate hike dissenters, the bank's UK mortgage book faces a parallel repricing that Citi's current model does not include. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.